labeling the millennials. I'm a millennial, technically. Like, I really don't like that. But I have noticed with this newest batch of first-time home buyers that they're really afraid of the commitment of buying a house. And like, I think that's an understandable concern, but I think people forget, like, if you were to take your credit report, and a credit reports how many months you owe for something. So if I look at a mortgage credit report, it says, you know, you owe $300,000, 360-month term. That's a long time, right? 360 months is a long time. But then if you were to then right below it write your rent down, like, what would be the term on that? Forever. Mm-hmm. Right? And then what would be the total price on that? I mean, let's quantify it. You know, you start thinking like that and you go like, you basically, the only way that wealth is created is through ownership. And I don't care if you own a piece of dirt, if you own a snowplow and you plow snow for a living, if you own a stock, which means you own a tiny little piece of a company, right? Or if you own a house. But the most accessible way for people is through housing. It's just a fact. I've been doing this long enough now. I've seen it. I've seen it over and over and over and over, where people are scraping by to make that first home purchase, and they're scared, and they can barely afford it. And then, you know, 8 years later, they've got $300,000 in equity, and they've had 2 more kids, and they want to move up, and now they have a chance, and they got promotions, and their jobs have changed, and they've had this stability of their house. And even through the market going down, right, you can still live in that house, right? You can't live in a mutual fund. You can live in a home. It doesn't matter if it's worth $1 and you bought it for $100,000. It doesn't matter. You can still live there, and you can wait it out. And we don't know of any time, like a 10-year span, a decade span, where the houses have started within that 10-year span higher than they ended that 10-year span, right? Now, for the people that sat it out and wait because the market was bad or things were happening, or, you know, now most of those people are really regretting that decision not to buy, right? So it's just a way that you can leverage your future. I really believe in buying a house as soon as you can, as young as you can. I personally bought a house at 21 years old. It was a Darby Estates condo. We bought it for $140. It went down to $90, and then by the time we sold it, it was worth, you know, $205. Right? Like, all we had to do was just pay that mortgage every month, you know, and then we rented it out. It's just, it's all the difference. It's how almost everyone in America can gain financial freedom is through home ownership. It's the only way. That's what I think. So I hope that helps.
I mean, we don't have a lot of that. You've been so generous with your time today.
I've got, this is my favorite thing to do. So the loan process is, it's interesting because a lot of people think that they are the loan process, and, you know, borrowers forget about the fact that they're only half of the deal. The collateral is the other. Like, if we foreclose, we get the house. You know, there's no such thing as debtor's prison. We can't keep those people paying us. So it's really important to understand the nature of what a pre-approval is and what it isn't. So in the loan process, the first thing that we need is a referral from usually our realtor friends, right? And I don't know if you guys want to talk or care about how to give a referral, but I can tell you, if you want to increase your conversion, you make sure that your preferred lender is calling that person, not the other way around. So the conversation looks like, I'm going to have Dustin Brumley give you a call, you know, his team's great, and then they're going to say, okay, sounds good. Or about 1 out of 10 times they'll say no, and then you say, okay, totally understand, you're not ready, I'll give you their contact information. The thing is, my motivation to call them versus their motivation to call me, like, I like feed my kids by calling them and make that connection. I'm about 1,000 times more motivated to make that connection, right? And then when I do that, I'm talking the realtor up, trying to set up a face-to-face connection. But that conversation looks like a pre-approval. So what does it take to get pre-approved? Well, what I'm looking for is I'm looking for a loan application, I'm looking for a credit pull, I'm looking for income and asset documentation. That's what I want to get you pre-approved. I want to make sure I have a belief in my team, and I have a belief that's long-standing since I've been in this business, that my reputation is more important than anything. So I want to have the reputation of never screwing deals up. And the way you don't screw deals up is you don't write pre-approvals without having all the pertinent documents. You don't get in a hurry. It's a little bit harder up front, that process, versus a lender who would pre-qualify someone without necessarily checking all the documents. That's what a pre-qualification letter typically is. But that's a much more risky proposition for a listing agent to take that, right? Because if they haven't seen the income, like, you would be amazed how many people actually don't know how much they make. It is stunning. Or, you know, they didn't realize that they couldn't use their Uber income because they've been driving for Uber for 2 months, right? Like, we need 2 years self-employed. So, you know, we need to go through all those steps. So that's the pre-approval process. Once we have that, we want to meet with them, consult with them, talk about their goals. As a lender, when we're pre-approving someone, there's 2 kind of facets. There's what do you pre-approve to, and what is your payment comfort range? Because a lot of times those things don't mesh up. So a lot of our clients are pre-approved at 600, but they don't want to go above 400, right? So we need to make sure to be communicating both of those things to our preferred realtors, because if you set them up on a search for 400 and under, but they can actually go up to 600, like, a lot of times, you know, what if there was that magical house at 420 that they missed? You know what I mean, right? And just a rule of thumb, every $10,000 is $50 a month, just so you know, in purchase price. $10,000 is $50. So a lot of people think it's a lot more, but it's not that much if you increase the price just a little bit. So the pre-approval gets done, and now they're out shopping for a house. Realtors, you're showing them houses, you write an offer, you get mutual. Once you have mutual, that's really where the rubber hits the road for us, for a lender. So now we're getting that contract. We are submitting it to processing. We're opening, you know, our side of title and escrow. We're getting all that done. You're gonna get the inspection. We're usually gonna either order the appraisal right away if it's a tight timeline, or wait until you have the inspection before ordering the appraisal. The appraisal is when they really get on the hook with us. Because remember, closing costs with a local lender, some lenders like charge the upfront application fees. The local lenders don't. So the closing costs are only paid at closing, except for the appraisal, which has to be paid when we order it. So we want to generally make sure that the inspection is good before we order that appraisal. But there's not always time if it's a super tight closing. So we just kind of play that by ear. And we go ahead and submit the file to underwriting. So a loan officer, when we do a pre-approval, our job is to say, how can we make this work? When an underwriter gets the file, their job is to say, how can we make sure this doesn't not work? Right? Does that make sense? So, like, the underwriter literally is never allowed to be a direct connect to the borrower. They can never talk to the borrower. They can't have an emotional connection. This is where having a good loan officer matters, because there are a lot of elements in lending. It is not simple. The FHA guidelines are 1,300 pages. There's a lot of things, one-offs that can come up and things like that. You get a loan officer that does a lot of business, right? Just like in real estate, it's a contact sport. Staying relevant, you know, having clout and good relationships with the underwriters. Because the good loan officer, what they're doing is they're being an advocate for your borrower when something gets kind of sticky, right? Or something gets kind of weird. So the underwriter, they are looking for problems. And they're not only underwriting the borrower, they're also underwriting the property and the title. Do we have any title claims? Does the borrower have any judgments that came up that might affect our lien position, right? Does the house look in lendable condition? Is the value there? You know, all those things. So we go through that underwriting process, and usually that consists of the underwriting sending out a conditional approval, and then us asking for more documents, and then an updated approval, and then more documents, and then hopefully by the second or third round we're done. We've got everything we need. During this process, we're going to send out the closing disclosure. The closing disclosure is the legal document that has to go out to the borrower 3 days before they can sign, right? They have to acknowledge it, and it's got all the final set of fees on it. So that's the CD goes out, we get final approval, we've gotten the appraisal back, everything looks good, all right? And then the file goes to docs. The docs go out to escrow. Escrow signs them. The clients at the same time are bringing in their cash, right? They bring that all into escrow. Escrow also acts as a notary, although that's not their primary job. So sign at escrow, docs are signed, and then we go ahead and fund the money. Usually a lot of times they'll sign the day before we fund. Sometimes we can sign and fund on the same day, right? When we fund the money, that means we send a wire for, you know, whatever, $336,232, whatever the balance is to complete that purchase price. That's the funding. So now it's all there, escrow gets it all, they disperse all the funds appropriately where it needs to go, to all the people, and then they record the document, and then, boom, they collect your homeowners.